faced with asking the most difficult questions about life, our society, and the world economy at large. The answers we seek are inextricably linked to the commitments we make and the actions we take. At the Institute of Certified Chartered Economists, ICCE, our commitment is to raise professional economists with the highest ethical standards through quality education and collaborative learning. Our global network of economists professionals are challenging conventional wisdom, advancing ideas, and contributing to the transformational agenda of the world economy. ICCE is raising economists globally, and you too can be one. Make the smart choice and become an ICCE charter holder today. Join the ICCE today and let's measure up. www.charteredeconomists.org.
Yes, good morning, good afternoon, good evening to you from wherever you join us from. Welcome to this very important webinar hosted by the Institute of Certified Chartered Economists, the ICCE. And I will just take the next few minutes to brief you about the ICCE, who we are, what we stand for, what we do, and why today and the topic for discussion is very important to us and to you that have joined us. So we're very excited that we have attendees join us from over 8 countries who are joining us for this webinar. Of course, today we have India's economy in focus, and we are very fortunate to have with us today a very astute economist, an Indian himself, who have lived through it all, decades of experience and insight on the Indian economy. So he will be our guest speaker for today, as we will welcome him later in the course of our discussion for him to take over and share with us his insight and expertise. Now, my name is Paul Frimpong. I'm the head of Global Membership Services at the ICCE. So when I share the information about ICCE, definitely you'll get to know more about what my role is. In the meantime, as I'll be sharing information about the ICCE, I'll also be putting some links in our chat box here. So if you have any further questions, of course, first of all, I'll put my email address there. So if you have any question regarding the ICCE or post-webinar questions, you might share that with me via email, and I'll be very glad to provide you. So I've sent my email to you via the chat box. So if you have any questions regarding the ICCE, I will share with you. So briefly, the ICCE, which is the Institute of Certified Chartered Economists, it's a qualification for people or individuals that are currently working as economists, or individuals that have the intention of pursuing a career as economists. And so the institute offers a qualification that makes you a member of a global movement of economists. So when you become a member, register as a member, there are a series of examinations that you have to go through, and once you pass these examinations, we will then receive certification as a chartered economist from the ICCE. Now, our vision is raising economic professionals with the highest ethical standards through quality education and collaborative learning. And these are our global leadership board. We have a governing council and international board of standards, and as well as the operational team. So these are the individuals that are behind the ICCE. So we have Dr. Franny Luthier. She's currently the CEO and partner of Sadbridge Investment, former World Bank Vice President. We have Professor H.K. Pradhan, who is a professor of finance and economics at SLRI in India, on the leading business schools in India. We have Dr. Mustafa Ibn Buama, Associate Professor of Economics at University of New Brunswick in Canada. Dr. Lalima Mukherjee, she's a professor of economics, University of Engineering and Management at Calcutta. Dr. M. Azhar Hussain, associate professor of economics at Rochdale University in Denmark. Danali Marcia, she's a chief economist for Dutch Bank, based in South Africa. And then we have Dr. Barun Taka, associate professor of economics at Flame University in India. Myself as a global head of strategy and membership. And then, of course, my colleague Garish Lag, who is the global head of partnership. So these are the individuals that are behind the ICCE as an organization. So in terms of membership, maybe you're asking how can you become a member of the ICCE? What's the minimum qualification? So you just need a bachelor's degree or equivalent to be part of the ICCE. Of course, if you're already enrolled into your bachelor's degree in your first year and upwards, you can also as well apply to be part of the ICCE. So we have examination that you will take. The examination pass mark 50%, and all our exams are computer-based testing. So you write your exams online anywhere you are in the world, at the comfort of your home. Of course, you will go through the examination verification system that we have to ensure that there will not be any form of malpractice or whatsoever. So that is how we structure. So in the curriculum, what is it that you're going to study as an ICCE learner? What are the various papers that are available? So in level 1, we have investment and micro and macro financial systems and development. Level 2, these are the courses you will take. Micro, macro, that's advanced level. We have Economist 1, corporate finance. And of course, in level 3, you have international trade, international finance, economic and business ethics, and of course, the advanced level Economist 2. Now, after these levels, level 1, level 2, level 3, as a learner, you get a chance to choose your specialization area. So you can become a financial economist, petroleum economist, energy economist, health economist, managerial economist, marine, labor, and industrial economist. So these options are all available for you to specialize in. Of course, you can specialize in multiple areas depending on your capacity and your interests. So the fees and everything are available. In fact, I'm going to share with you all the links in that chat box. And of course, we have scholarships that are available for our learners. So if you are worried about the fees we pay, which of course is of course very accessible and affordable, but then again, we also offer scholarship opportunities for our learners. We have 4 types of scholarship currently running. We have Future Economist Scholarship, Women Economist Network Scholarship, Media Professional Scholarship, and of course, Faculty Scholarship. We have full details of these scholarships and the eligibility criteria available on the ICCE website, which I'll share with you in our chat box. So again, with the ICCE, we also offer advisory services to government and organizations that are looking to, especially business that are looking to invest or penetrate into the emerging markets, i.e. Asia Pacific, Middle East, and Africa. So if you need advisors, consultants to help you in these markets, the ICCE offers such services as well. And of course, with government, we help them in drafting their policy guidelines, FDI, foreign direct investment policy and programs, and all of that. So if you need services in any of these, if you work with a government agency that needs economists and consultants to help them, ICCE offers such services too. So that is about the ICCE. And as I said, if you have any questions regarding the ICCE and what we do, you can reach out to me via email in the chat box. I'll put it there for you to be able to reach me. So thank you very much for this audience. And then I will zoom into today's webinar, which is on the Indian economic and banking sector outlook, views and visitors for 2022. So today we are very privileged to have an astute economist, a chief economist for that matter, for so many decades, with us to share with us these insights, which I believe all of us have joined have interest in this conversation. So I will take this opportunity to say that, okay, so in the course of conversation, in terms of the presentation that will be made by our speaker, if you have any questions, please, there's a Q&A button. Those of you who are familiar with the Zoom platform, we have a Q&A session there. You can put in your question, and at the end of the presentation by our speaker, all those questions will be addressed by him as well. So if you have any question regarding today's conversation, please do not hesitate to send them through the Q&A button, and I will read it out to the speaker after his presentation so that he will address them. We want you to be part of the conversation. It's very important. This is a webinar, and so we would like to hear from you in any way that you can. If you have questions about the ICCE, please do drop them as well. And of course, if you have questions about the webinar, please send them through, and we'll be happy to address them. At this point, I will take the opportunity to welcome our speaker for today, Dr. Manoranjan Sharma, who is currently a chief economist for Infomerics Ratings. I will give him the chance to tell us briefly about himself, and then after that, he will zoom into his presentation. Dr. Sharma, please, we are very privileged and we welcome you to take over and share with us your perspective.
Well, thank you very much, Professor Frimpong. Am I audible?
Yes, you are very audible.
Oh, okay, thank you. I'm grateful to Professor Frimpong for very kind and generous words. As he said in his introductory remarks, I am currently the chief economist of Infomerics Ratings, which is a rating company, as the name suggests, in India. And in India, we have only, I think, 6 or 7 players in this space. So it is doing a significant work in a variety of ways. Prior to that, I had experience for about 35 years in diverse institutions such as National Bank for Agriculture and Rural Development, a Small Industries Development Bank of India, and finally, I was the chief economist of Canara Bank, general manager and chief learning officer of Canara Bank for about 17 years. So with this background, I have interest in diverse areas, and when Professor Frimpong asked me to address on this issue, I happily accepted. So let me come to this issue of Indian economy and the banking sector. I have a brief PPT with me, so I'll try to share this PPT so that, just a second.
Just a quick one. Is it possible you can move your camera a bit away from you? It's too close to you. If you can move it back small, your laptop.
So, well, these are difficult times, as all of us are aware. These are times of great turbulence, times of great challenge. The present COVID-19 times has sometimes been compared to the global financial crisis of October 2008, even the Great Depression of 1929. Sometimes comparisons have also been made to the Spanish flu of 1919. So this is the magnitude of the crisis, perhaps the first time we are facing in a century. So I'm reminded of a very powerful thought which Albert Einstein, one of the greatest scientists, said, that you cannot solve a problem on the same level that it was created. You have to rise above it to the next level. So given this kind of a background, I do think that there is need for some innovation, some creativity, some out-of-box thinking to discharge the responsibilities that we have here today as thinking persons. Basically, what we try to look at here in this presentation is I would look at the factors driving the economic revival, global and domestic sentiments, measures for growth ahead, and how the banking sector can work as a catalyst. Now, let me come first to what are the factors driving economic revival. As some of you would be watching the Indian economic scene or be aware, last year, post-COVID-19 was terribly bad, in the sense that in the first quarter, there was a contraction of 23.9%, followed by another shrinkage, another contraction of 7.4%, with the result that the full year in India means, unlike the US or other places where you follow a calendar year, in India we follow what is known as a financial year, which runs from April to March. So the full year for the year ended March 2021, India had a contraction of 7.3%, a shrinkage. Now, to place matters in perspective, I would like to submit that prior to this, the earlier GDP contraction we had was in the year 1979. So this means that this was the first time India was confronted with a challenge of this magnitude in about 40 years. So obviously, this has very serious implications for the Indian economy. However, it is a matter of some satisfaction that post this ravages of the pandemic, things have now started showing discernible improvement, whether you look at the data in terms of what we call in India on a YOY basis, year-on-year basis, or whether you look at sequentially. So here, even if you look at the second quarter of this year, both private consumption and investment spending rose by 12%, manufacturing, construction 8 to 9% higher than the previous quarter. There's also been sharp rise in exports of over 100 billion US dollars. In terms of Indian rupees, it translates into what we call rupees 7.6 lakh crore in Q2. Some of the major growth drivers at the present stage of development are stock market. Obviously, some of you may be following the capital market, doing exceptionally well. BSE, I think for last 3-4 months has consistently breached the 60,000 level. Obviously, in the last 2-3 days, the last a week or so, it has come down a little by about 2.5%, about 58,000 or thereabouts, but still largely it has been above 60,000 levels for the last 3-4 months. There has been very strong tax collection, both from the side of the direct taxes and the indirect taxes. In terms, we rolled out a major measure in terms of indirect taxes called GST, Goods and Services Tax in India. And in case of direct tax, one important benchmark in India has traditionally been the advanced collections of income tax and other taxes. They have also been very well. Corporate profitability is in some kind of an upswing. And interestingly, what we find is that there is a shortage of skilled laborers. This, to my mind, reflects rising jobs again in the formal sectors. Now, if you look at advanced tax collection, those surged from 3 lakh crore in the period April-December 2020 to rupees 4.6 lakh crore this year. Very significant rise. Profits across companies have also risen because of austerity drive, higher production, and capacity utilization. Higher government expenditure has also significantly contributed to this pickup in growth. The net direct taxes have grown by over 60%. I've given the figure, so maybe I'll just run through the presentation, because I think this should be available to you. And there's been some kind of a debate and discussion. Why is the Indian stock market, why is the Indian capital market doing so well when the broader macroeconomy, when the Indian economy at large is not doing all that well? So I have tried to explain why there could be a disconnect between certain segments of financial markets and the real sector. And it is my submission that this is a situation which is not unique to India, and it conforms to the global trend of exuberant equity markets despite reducing consumption. Now, in the last 2 years or so, post the pandemic, while almost all sectors and segments of the Indian economy have been devastated, by and large, what we find is, if you do some kind of a disaggregated examination, some kind of a granular analysis, you'll find that all those sectors which are contact intensive, sectors such as the informal sector, micro, small and medium enterprises in India, aviation, tourism, logistic and hospitality services, all these sectors bore the brunt of this devastation wrought by COVID-19. By and large, what you find is, and I think this is in conformity with the global norm or in diverse parts of the world, is that by and large, IT industry services have done fairly well. Now, let us look at some indicators of why do I say is the economy rebounding, growth is gaining traction, we are on an evil keel once again. I've tried to look at the September 2021 figures primarily for two reasons. One is, most of you would be aware that in India, as everywhere else, the data comes with a slight lag. And in India, what we call the financial year, half year, and the year, final year figures. That means September and March figures are considered to be broadly representative of the larger macroeconomy or financial sector. So there could be some month-to-month volatility. To iron out those kind of volatility, I've tried to look at the September figures, which are widely accepted, that these half-year figures are said to be far more representative than the monthly figures. So if you look at the September 2021 indirect tax collection GST in terms of Indian rupees, this was a level of 124 lakh thousand crore. Corporate bond issuance were on the rise, suggesting business recovery. September, we raised about 83,000 crores. Capital market, as I said earlier, BSC breached 60,000 levels. Uh, Foreign portfolio investments inflows, both in terms of debt equity, rose again. September 2021 figure being almost 4 billion. Moderating government securities, September 2021 figures 6.16. And what is interesting is that the core sector output uh, was higher than even the pre-pandemic levels. In August 2021, we recorded a growth of almost 12%, which is very heartening. Foreign exchange reserves, India has been doing consistently well in the last few years, but now we seem to surge from one peak to another, and it reached a level of 640 billion. Now, fiscal deficit is one aspect which has been discussed and debated considerably in any discussion. But here, in terms of the fiscal deficit, we seem to be well on track to, till October, 36.3% of the budget estimates, because of this surge in tax collections. There has also been both direct and indirect tax collections, and all this has been facilitated by greater use of technology, data mining, both in direct and indirect taxes. Another factor which I'd like to draw attention is the fact that declining pandemic and rising vaccination. Today there was some news item published prominently in Indian newspapers, also highlighted in a lot of electronic channels, television debates, that about 75% of India's adult population has received both doses of the vaccination. So this has also given some kind of a comfort going ahead. Now, India, we have some high frequency indicators. Why do we call them high frequency? Because these data are available quickly at the end of a month or so. So whether you look at power collection, consumption, tax collection, all these are strongly suggestive of robust growth in GDP. But there continue to be persisting concerns of supply disruptions, rising input prices, and in India, as everywhere else, possibly we have again a new variant of COVID-19 characterized as this Omicron virus. In cases of companies, what we find is that there has been significantly higher profitability. And this kind of profitability is not inexplicable. It has been explained in terms of an austerity drive launched by companies across the spectrum, but it is necessary for companies to continue to shore up their bottom line for sustained growth. Now, recently, the Reserve Bank of India, which is the central bank of the country, brought out several reports in which they highlighted that despite Omicron concerns, upbeat consumer and business confidence, rise in bank credit, resilient aggregate demand, and higher Rabi sowing augur well for India. In India, we have primarily two sowing seasons, Rabi and Kharif. So this Rabi season, which is the ongoing right now, so this is again doing well. Rising vaccination has facilitated demand transmission from goods to contact-intensive services and real estate. However, one major area of concern which has emerged is that the skew inequality in terms of income and wealth seems to have widened. Again, this seems to be a global phenomenon, but this is something I think all of us must put our heads together and try to address this issue. In case of India, what you find is that growth has been powered by IT services, autos, pharma, mobile phones, and technology startups. Ultimately, sustainability of the growth process depends on health of corporate balance sheet, world growth, policy certainty, and domestic growth. Now, this gives you some kind of a good picture that growth is gaining traction, that we are again quite upbeat about the process and pattern of the emerging Indian economy. However, if you look at the Indian scenario, all is not hunky-dory. There continue to be some issues of concern, and I'd like to highlight that private investment in the second quarter, July-September, was up only marginally from FY20. Consumption still seems to languish. In India, we have a system called Narega, in which poor people are given assured employment at maybe 1,000 rupees per day, which you translate into something like $15 or even lower by US standards. So the demand for jobs under the Narega, it suggests that there continues to be significant distress, significant problems in the rural sector. Another area of concern is that India's labor force participation fell to 40.9%. And to place matters in perspective, I would like to submit that this is one of the worst ratios in India. And the usual comparison of India and China, if you do that, you'll find that the Chinese ratio was at 66.8%, almost 67% in 2020. Automobile sector, which is sometimes considered to be representative of a large and growing economy, has also been hit by shortage of semiconductors. Export-oriented sectors, while exports have done well, particularly sectors such as pharma, textiles, engineering goods, have been hit by rising input costs with consequential adverse impact on their competitiveness. I think Professor Frimpong has been very kind to give me, so I'll skip through some of the slides. I'll just highlight that there continues to be a dichotomy between financial markets and the larger macroeconomy, and the sustainability of this skewed and asymmetric development has caused widespread debates and discussion in the Indian economic scene. In India, we have 6 measures of inflation. The two most widely used measures are the WPI, Wholesale Price Index, and the Consumer Price Index. Now, Wholesale Price Index rose to a 12-year high of 14.2% in November because of higher prices of food and manufactured goods. Going forward, while all of us are sanguine, all of us are very hopeful that maybe we'll end this financial year with a growth of something. Again, today the economic survey was presented by the Honorable Finance Minister. So we are hopeful that we'll end this year with a growth of 8.5 to 9%. Here, what I will try to highlight is that if you look at the position of the broader Indian economy, there are basically 4 engines of growth. These are domestic consumptions, government expenditure, private investment, and exports. So given the kind of macroeconomic hit, debilitating hit caused by the COVID-19 pandemic, maybe we could provide focused attention on all these 4 engines of growth. This is also essential because in the present stage of India's development process, creating jobs is critical to recovery together with boosting demand. Now, if we look at the global position, what we find is that global economic prospects are characterized by unequal vaccination among countries. This is one aspect which has been repeatedly highlighted in all their publications, whether you look at OECD, Organization for Economic Cooperation and Development, the IMF, International Monetary Fund, the World Bank, International Bank for Reconstruction and Development. There has been, I refer to the position in India about this deplorable aspect of rising inequality. But if you place things in a global perspective, you find that this is almost a situation all over the world, that we find a situation of rising inequality. The third pandemic wave, inflationary spiral, GDP growth headwinds for US, Germany, and China, and higher goods prices because of pandemic deficits cause global concerns. Now, given this kind of a broad macroeconomic setting, central banks all over the world are forced to resolve a very complex growth inflation trade-off because of supply side disruptions and rising prices. There has been divergent currency movement with the dollar on the rise and feeble yuan Chinese currency, all this which make the task of policy making difficult, particularly in emerging economies. Now, recently, the Fed came back, announced a statement, the Fed Reserve of the US, and they have strongly indicated that there could be a possible rise in March. If I were to quote their exact words, I think they said something like a rise would soon be appropriate. Now, this kind of a rise is anticipated because the Fed Reserve in the US is combating, is trying to aggressively counter a 4-decade high inflation and supply chain disruptions post-pandemic, and winding down asset purchases to power growth. Now, in this kind of a situation, emerging markets, a group to which India belongs, they must prepare effectively to ward off capital outflows and currency depreciation. This is obviously a difficult policy trade-off between rising debt and inflation or fostering recovery. There cannot be a one-size-fits-all approach to this kind of a complex move. How the Fed Fed move will impact countries across the development spectrum is difficult to say. The response of each country, in my submission, has to be based on their distinctive circumstances and vulnerabilities. Now, coming to global banking, recently, I think about 2 weeks back, McKinsey, one of the leading consultants all over, they have published a global banking review for 2021. This is a very important publication. Probably most of you may not have read it, so let me highlight the basic finding of this report, which shows widening gap between leading banking institutions and laggards. However, they foresee a decent baseline for 2022 to 2025. They have visualized a return on equity of 7 to 12%, which is reasonably good because of shift from convergent resilience to divergent growth. Now, in their excellent study, McKinsey has identified 4 factors why this divergence, in their view, stems from. And they have found that this divergence stems from geographies, relative scale, segment focus, and business model. Now, in this kind of an environment, McKinsey has stressed customer ownership with embedded digital financial services, efficient economic model, fostering growth beyond balance sheet, constant innovation, and fast go-to-market, leveraging technology and talent. Now, these, to my mind, are important points, and they must be looked at seriously by all watchers of the global banking scene. In India, we have significant macroeconomic risks. Obviously, they include inflation. I've mentioned that there continues to be a divergence between the wholesale price index, which has been consistently breaching the double-digit numbers in India, even though CPI, Consumer Price Index, is not such at a high level. There are issues of glide down of accommodative monetary policy. Monetary policy in India, as in most parts of the world, has been overtly accommodative in the aftermath of the pandemic. And now, once this kind of an accommodation is reduced, it could cause some hardship and some pain to diverse sections and segments. So this kind of a glide down has also to be carefully calibrated. Fiscal crunch in India has been a very serious problem, where the Financial Fiscal Prudence and Budget Management Act. So for a country of the size and magnitude of India, normally it is considered that up to 3.5% of a fiscal deficit is reasonable and can be easily managed. But going ahead, the requirements of growth and the requirements of fiscal prudence are going to be difficult to be managed. We have the budget, union budget in India. The Honorable Finance Minister should be presenting the budget tomorrow. So we'll see how she goes about this. Now, NSO, National Sample Organization, which looks after GDP, have projected a growth of 9.2% this financial year, which is lower than RBI's 9.5% December projection. Basically, apart from low base effects, some segments, as I said earlier also, contact-intensive sectors such as trade, hotels, transport, and communications have been completely crippled in the wake of the pandemic, and private consumption and investment continues to be muted. Now, coming to the banking role of the banking sector in India, when any discussion of banking sector has to be done with a reference to what is called in India scheduled commercial banks. This is broadly used as a synonym for the banking industry in India. Scheduled commercial banks are those banks which are listed in the second schedule of the RBI Act 1934. But here, what I wish to highlight is that even though there is some kind of a tendency to paint all banks by the same brush, that is not a proper way to go about things, because the SCBs, or the banking industry in simpler terms, is not a monolithic category. There are significant differences across what you call public sector banks and private banks, and even within these two groups. By and large, what we find, again, there could be some notable exceptions, but by and large, what we find is that private banks are better placed to withstand post-pandemic challenges. The Reserve Bank of India, which has been the central bank of the country, has consistently reduced the repo rate. By March 2020, it has reduced the repo rate by 115 basis points, or 1.15%, and reverse repo by 155 basis points. But still, at most points, there continued to be surplus banking liquidity. Now, what you find is that there has been low demand and increased banks' risk aversion. This has kept credit low. The issue of risk aversion is a very complex issue. I think within the constraints of the time that I have at my disposal today, it will not be possible. Suffice it is to say that the bankers are subject to a lot of accountability, due diligence issues, and when the loans go bad, all the decisions are placed into this scanner. So this causes some justifiable concern. Banks have become far more cautious in their lending behavior. There has been negative bank rate growth across several important sectors, decline in major industries, One issue of banking sector, which comes of repeated discussion, is the issue of defaults and delinquencies, non-performing assets, non-performing loans. But here, non-performing assets, as I said in earlier, in the case of scheduled commercial banks, these are not uniform either across bank groups or across sectors. Now, coming to the end, what you find is that if you place things in a proper historical and comparative perspective, you'll find that COVID-19 will have enduring impact across industries. And since banks are some kind of a microcosm, a miniature model of the larger economy, obviously COVID-19 will have a significant debilitating impact on the banking sector. Consequently, banks need to be adequately secured with their assets, qualitatively strong and amply capitalized. Size is essential, but efficiency is even more so. Shift from transaction banking to business orientation is all the more necessary at the present juncture. By and large, there seems to be complete unanimity across the board in India, whether you look at the owners, government of India, or you look at the Reserve Bank of India. Most discussions, IBA, which are the representative body, that the focus of banks and the top officials in India can no longer merely on what we call the top line growth, the growth in banking business, but the ultimate reflection of the efficiency, productivity of a bank has to be a manifestation of the kind of bottom line they are able to come up. The performance in terms of profits and profitability has to be given greater attention. Going ahead, there has to be a sharper focus on risk management to detect vulnerabilities and capture risks with changed external environment and best practices. Operational risk is becoming increasingly important, particularly frauds. We have a very unpleasant situation of rising frauds in India, both cyber related and otherwise. Here, consequently, an effective warning system and forward-looking test framework has been implemented in almost all banks, but possibly there is need for greater focus on this kind of a thing. Another issue which I'd like to highlight is the issue of appropriate compliance culture, transcending legal binding with broader standards of integrity and ethical conduct. Here, I would like to highlight the example of Habib Bank, which at one time was used to be Pakistan's one of the largest commercial banks. It was fined US dollar $225 million by Fed Reserve in the US. So this kind of penalty by the regulators, whether by the Fed Reserve in the US or Bank of England in England or by the Reserve Bank of India in case of India, this works as some kind of a double whammy. One, of course, is the simpler aspect that at the present juncture, when the banks find it difficult to produce significant numbers in terms of profits and profitability, any outgo by way of regulatory penalties will dent their profit pool even that much further. But this is one part of the story, and to my mind, this is small part of the story. The much more devastating part is that these days we are all of us are familiar with a wide variety of risks that banks are subject to, risks such as credit risk, market risk, operational risk, foreign exchange risk. But well, apart from these risks, banks are subjected to what we call reputation risk very significantly, because the kind of banking model we follow all over the world is banks keep a very small proportion of money which is mobilized to deposits with them. Rest all is deployed either in productive lending or it is used in investments. So given the very nature of things, no bank anywhere in the world would have position to meet the claim as defined in terms of the RBI Act 1934, that the bank should be in a position to meet the claims of its depositors as and when they accrue. Here, the crucial words to which I would like to draw attention is the words as and when they accrue. So, given the very nature of the banking business model, no bank is in a position. If there were to be a run on the bank, I think there's very rich international experience all over the world in all about 200 countries, that given if there's there are hardly any bank which will survive for more than 60 minutes or at the most 2 hours. So I have several examples. I've done some work in this area also, but I think because of the paucity of time. But suffice it is to say that in case of a run on bank, there is not even God or even any God, whether Jesus Christ or the Hindu or the Islamic God, no God can save the banks or the bankers. The bank will go down under. So this is the magnitude of the kind of reputation risk that banks are faced. Consequently, a good governance framework, effective risk and compliance culture, proactive buffers, banks, NBFC is also important part of the financial segment. NBFCs in India mean non-banking financial companies. Globally, at a larger level, it is sometimes used synonymously with what is called, broadly called, shadow banking. So maybe we need to assess the impact of the COVID-19 pandemic on their balance sheet, asset quality, liquidity, profitability, and capital adequacy. Now, as I said earlier, banking sector is not to be seen in a silo. It is a microcosm of the larger macroeconomy. And what you find in India is that in the last 4 or 5 years, the banking sector has been devastated by what I call a triple whammy. Earlier, we had demonetization, followed by rolling out of the goods and services tax, and then the impact of the COVID-19 pandemic. All this led to weakened banking, rising NPAs, and credit growth. There has been some projections done by the Reserve Bank of India, some other bodies. The Reserve Bank of India brings out two very comprehensive reports called the Financial Stability Report, twice a year, biannually, in July and January. And there are some fears that NPAs, which are presently at about 8% of total loans and advances of the banking loan book in India, could surge to, from 8%, they could surge to 10 to 13% by the end of the financial year 23. Consequently, legal and non-legal measures such as National Asset Reconstruction Company, Prompt Corrective Action Framework, capital buffers for small finance banks, asset reconstruction companies, all this could be useful in strengthening the recovery environment for the banks. Basic issues at the present juncture, banks are confronted with are modest capital buffers for most public sector banks, high level of NPAs, even though I'm aware of the fact that in the last 2 years, the NPAs have come down from a level of about 10.5 lakh crore to a level of about 8 lakh crore. So roughly in the last 2 years or so, the NPAs in percentage terms have declined by roughly about 25%. But we cannot rest on our laurels. We have to ensure that this kind of a curb, this elephant in the room, NPAs, has to be tackled on a war footing and on an ongoing basis. Now, Reserve Bank of India's latest very comprehensive tension program of banking, which is considered to be the most authoritative publication in India, shows that 5% higher bank lending took place despite 7.3% GDP contraction. But given the collapse of IL&FS in India, Diwan Housing, Shrey, Reliance Capital, non-banking financial companies, what you call broadly shadow banking, need to be ring-fenced because of the systemic risk implications. Recently, RBI has reiterated its instructions on what they call systemically important banks, DSIBs, and they have once again stressed that SBI, ICCE banks, and HDFC continue to be domestically systemically important banks. Another one most important area of concern is that in the emerging recovery environment, IBC, Insolvency and Bankruptcy Code 2016, made a significant improvement. Obviously, the provisions of the Act, the coercive actions envisaged have taken a backseat because of the damage caused to lives and livelihoods post-pandemic. But overall, the enactment of this has made a significant difference to the recovery ecosystem in India. Going forward, post this crisis, we see three kinds of banks emerge in India. One is truly digital capabilities and cost elasticity. The second are the banks that are digital laggards. They need to do a lot of catching up. And the third are the banks which are not doing adequate efforts, so they will struggle to survive. Concerted efforts have to be made on the capital front, on the NPA front. So this looks to be a little difficult, challenging, but I'm reminded of the Bible. One of the very powerful thoughts in the Bible is, this too shall pass. Similarly, a very famous Russian novelist, Dostoevsky, wrote in a very powerful book, Crime and Punishment, the darker the night, the brighter the stars. English poet P.B. Shelley wrote in his classic poem, Ode to the West Wind, if winter comes, can spring be far behind? We are going through difficult times. The road is full, the tunnel may be long, the tunnel may be difficult, but I'm confident both the Indian people and the Indian banking sector, as indeed at the global level, have always displayed immense dynamism and resilience. And this is a new normal that we find ourselves in, but I'm confident that with the kind of resolve all of us have shown, whether in India or abroad, with coordinated and concerted attempt, we shall overcome. I think I'll close here, and I'd be happy to take any questions, any queries that you may have. Thank you very much, and I'm particularly grateful to Professor Frimpong for having me with you here. Thank you.
Thank you very much, Dr. Sharma. I think we all agree that that was a very insightful, very detailed presentation that you've just given us. The insights were very massive, cutting across from global perspective to drilling down to the Indian economy, and of course, more specifically, the Indian banking sector. As you mentioned, it's not happening in isolation. It's as a result of all the economic underpinnings. That is the replica of the banking sector. So if the banking sector is not doing well, then of course you should have an idea what's happening in the entire economy and vice versa. So thank you very much, Dr. Sharma, for those insightful presentation. At this point, as I did mention earlier, all of you will have the chance to ask questions that you have. So if you have questions, please do send them to us by the chat box or the Q&A button, and I'll read these questions to Dr. Sharma to address. But my first question, before I read any question that has come in from the audience, Dr. Sharma, is to ask you, earlier on when you were doing the presentation about the Indian economy, you mentioned a bit about what we call the income inequality, which is can be a very worrying trend if it's not taken care of. So I would like to ask you, how equitable, of course, in the midst of the COVID-19, we can see vaccination and who is vaccinated, who is not vaccinated, who has given the chance to actually start working and who is not. All of that can also contribute to the widening gap. So I would like to ask you, how equitable is the growth trajectory of the Indian economy? How equitable is it? And in your opinion, what could be the very important measures that the Indian government can put in place to ensure that they can close the gap between the haves and the have-nots. So that's my first question to you. So if you can address it, then I'll move on to the next question.
Thank you very much, Professor Frimpong. You referred to the issue of income inequality. Globally, this has emerged as one of the most important issues in ensuring that the process and pattern of economic growth all over the world is broad-based, is equitable. In India, pioneering work in this kind of area has been done by an institution called Oxfam, and they have brought out a scary picture that income inequality as measured in terms of the standard benchmark used all over the world, technique called Gini coefficient. In terms of income inequality, distribution of income and wealth in terms of the Gini coefficient has worsened. So I think all the policymakers, planners, bankers, central bankers, they are on board. And this is why we find, and I think tomorrow we have a very important day in India. We would have the union budget tomorrow. So given the kind of overall situation, we find that there has to be a sharper role, a sharper thrust on the role of micro, small and medium enterprises, informal sector, and all this across regional disparities have become very important. So we do believe that all these things would be addressed to the extent possible. One other issue which I wish to highlight, both in case of this growth process which you asked, is that post-pandemic, the rules of the game changed completely. We're living in a different world, and both in India and in different parts of the world, both monetary policy and fiscal policy, they have worked in tandem to alleviate the pain and suffering of the miserable people, of the people at the margins, the poor, the vulnerable, the marginalized sections of society. What in India, Mahatma Gandhi, now widely considered in India to be the father of the nation, called the teeming millions of India. So these are some of the issues of concern, and I'm sure both the monetary and the fiscal policy, attention to aspects of distributive equity, attention to the informal sector, attention to the needs of micro, small, medium enterprises, agriculture, regional imbalances, all this taken together will do their bit to reduce the extent of skew, the extent of inequality that we find, and the growth process would be broadened and enhanced. Thank you.
Thank you very much. That was very in-depth, and I think we'll ensure that all these insights are made available. So again, if you have questions, please do send them through about what Dr. Sharma has presented. We'll be very much happy to read them out so that he addresses them. And after today's session, of course, we'll make the video. This is being recorded. We'll make it available on our YouTube channel, the ICCE YouTube channel, and of course on our main website, the charteredeconomist.org website. So you can visit and rewatch and share with your friends and colleagues who were not able to join us. So, and we also do an email to all registered attendees, so you can have access to the link to join and watch the video after this session. So with this, I would like to go on to ask my next question. So we're discussing about the Indian banking sector. And of course, in order to put things into proper perspective, it would be also good to understand fairly what is happening in the region. So in the region that India finds itself, the Asia Pacific region, what has been the strength and the capacity, and what has been the role that the Indian banking sector is playing? Is it seen as a leading player in the region in terms of the banking sector, and what is the trend happening in the region in terms of the banking sector? Yeah.
Well, thank you, sir. But let me take a few minutes to place it in some kind of historical context. Some of you may be aware that I think almost 20 years back, in October 2003, two persons from Goldman Sachs based in US, one was the US gentleman called Professor Dominic Wilson, the other was an India Indian lady called Rupa Purushottam. They came up with a report which, for the first time, earlier traditionally population was considered to be some kind of a drag on the process and pattern of economic growth. For the first time, they brought out the significance of what became known or became some kind of a buzzword all over the world as demographic dividend. So there have been large number of studies, researchers since then that going ahead, India is going to occupy its own place in the sun. The Indian growth story is here to stay and flourish. In this kind of a scenario, when India is increasingly finding its role and muscle, banking sector obviously is also certain to get strengthened over the years, though there may be occasional hiccups. In India, apart from strengthening the balance sheet, there has also been significant organizational changes. The consolidation of public sector banks has been an important step, which was considered for last 20 years. But I have published several papers on this, so I do believe that while consolidation is good, and I keep using an analogy which says that uh, the evidence in regard to consolidation is quite mixed all over the world. So, for consolidation, earlier there used to be 19 public sector banks, now they are reduced to 12. Attention has to be paid to aspects of due diligence, to compatibility in terms of HR culture, compatibility in terms of kind of the vision, mission, technology platforms. Otherwise, there's a very famous saying in England, goes back about 1,000 years or more: if you marry in haste, you will repent at leisure. So I think this marriage has to take place with open eyes and open ears. I'm happy to say that all these aspects of due diligence, of same technology platforms, similarity in HR cultures was taken into account when the government of India went in for this kind of a mergers on a large scale. Going ahead, I think all banks are showing significant improvement in terms of their financial position, in terms of their profits and profitability, in terms of their preparedness for technological upgradation. And I'm sure going ahead, good days are ahead for the Indian banking sector and the Indian economy. Thank you.
Okay. All right. Great. Thank you very much. So I have a question from Professor Lalima Mukherjee. She's one of the governing council members of the ICCE, and she's a professor of economics in India. So I'll read out her question. So she's asking, from the economic point of view, how long will the Indian economy take to revive or recover, as it were?
No, I think the revival process is already on. And last year, as I said earlier, you may be able to recall that in the year ended from March 21, we had a contraction of the level of 7.3%. First 2 quarters were terribly bad. So we technically went into a recessionary phase also. A recession, as some of you would be aware, is technically defined when you have 2 consecutive quarters of not just deceleration, of a contraction, of a shrinkage in GDP growth. This happened in the financial year in India in 2021. Now, even if we look at the most pessimistic worst case scenario, it's widely agreed that we will end with a GDP growth of something in the region of about 8% this year. By most watchers of the Indian economic scene, expected to in the range of about 8.3. In fact, we have stuck our neck out at Infomerics ratings. We have visualized a GDP growth this year of 8.3%. So obviously growth is gaining traction, but apart from the needs of growth, as I said earlier, we have also to take into account the needs of distributive equity, the needs of people who have been devastated by the COVID-19 pandemic, a special focus on lives and livelihoods, thrust on regional imbalances, micro, small and medium enterprises, informal sectors. So all these have to be an integral part of a comprehensive strategy to take India forward and I'm sure going ahead, we are in for much better times. Thank you.
Thank you very much. Thank you. So this is going to be my last question, and then read a question from. Okay, before that, let me read this question. So this is from Badru. So he's asking if we can highlight some information on expenditure tax, the speaker's view vis-a-vis the present income tax. So I'm sure it's something that is internal. Is asking about expenditure tax and income tax in India. I don't know if you can relate to what the Badru is asking.
I missed your question. Can you repeat your question once again, sir?
So Badri is asking about, expenditure tax and income tax. He wants to get your views on it. And I'm asking, maybe you can relate with this. In India, maybe there's an issue that's going on about expenditure tax and income tax. So he wants to understand, I think, the relationship in this regard.
Well, in India, the expenditure tax is broadly subsumed in this category called, which was introduced about 2-3 years back in lines with the international best practices all over the world, called the rolling out of the goods and services tax. So this is an indirect taxes, in income tax, corporate tax, some other taxes, they form part of the direct taxation. But in both cases, technology, data mining, all these things have been increasingly used to accelerate the to enhance the efficiency of the tax system, reduce the cost, and ensure that the extent of tax avoidance, tax non-payment of taxes, this is plugged. These holes, these gaps are plugged. So in case of both the direct and indirect taxes, expenditure tax, income tax, expenditure taxes now usually comes in this, all this is covered under what we call the GST, goods and services tax. We are significantly moving ahead by plugging all the gaps by which some of the provisions earlier were misused. Thank you.
Great. So I will ask my final question, Dr. Sharma. So it's regarding the Indian rupee, which is about the currency. Of course, we all understand the pressures that can be on a currency of emerging economy like India, respect of as against other trading currencies like the dollar or the euro or the Great British pound. So I would like to find out what has been the trajectory, what has been the strength of the rupees, and how can it be strengthened against other major trading currencies. So that's what I want to ask about.
Well, the rupee, Indian currency, what we call the rupee in India, has certainly taken a hit in the last few months. Now, possibly at compared to the US dollar, and Indian rupee maybe at 74 levels, so thereabouts. So going ahead, because of the high rate of inflation, maybe the rupee could tumble a little more, but we expect it to be range bound. Despite there could be some occasional volatility, but by and large, we do not see any major area of concern. Maybe some minor corrections could be here or there, and some cases this is both good and bad in several ways. For example, if the rupee value forms, then India's exports become far more competitive. But then on the other side, we have the situation that India is a huge importer of what we call POL, petroleum, oil, and lubricants. We import something like, I think, 75 to 80% of oil requirement. So our import bill will go up significantly with the rupee value to drop. So this is a complex and a multi-layered issue, and all these aspects have to be carefully considered before before taking a particular call. Thank you.
Thank you very much, Dr. Sharma. I think it's been a very, very insightful conversation with you. And it's been a very huge pleasure for us and for everyone that has joined us on behalf of all the attendees. We say a very big thank you to you, of course, with the ICCE We say a very big thank you to you for spending time with us and sharing all these insights with us. It's very much loaded. And as I said earlier, this is recorded and make it available on our YouTube channel, and of course also on our website. So Dr. Sharma, we say a very big thank you to you for this presentation and all the answers that you've given, which are very much insightful. And I believe all of us who joined this webinar today have learned so much about what is happening around the global front, and of course, Indian economy specifically. So we'll make this recording available. So thank you very much for joining us, and we hope to come your way soon. So.